Hi, everyone. Welcome to the YX webinar today. Today is August 27th, just after the market close. So let's get started. All right. So part one. So in this first section, we're going to talk about which presidential candidate will cut the budget deficit. So the national debt currently is $35 trillion. And the difference between national debt and national deficit is just that to fund the deficit, which is if the government's spending more than it accrues in revenue, the government has to issue debt. And the national debt is accumulation of the past government borrowings to fund the deficit, as well as the interest they have to pay on the debt. Currently, this isn't a big issue because the debt ceiling has been suspended until beginning of next year. And the new debt limit, because it's a suspension, the new debt limit at the beginning of next year will just be whatever that's outstanding at that time. And if there's no resolution to the debt ceiling, the US Treasury can take certain extraordinary measures, which means, accounting tactics, suspending certain investment flows, or redeeming some investments early that it has a control. So it can still go on for a period of time until it really runs out of money. So far, as you can see, that the total deficit for each year has essentially ballooned since COVID. A lot of it went to the fiscal policies to address the COVID recession. But as a percentage of GDP, it is extremely high right now at 123%. And I think this will come into, so just remember this chart. This will be relevant for later because it has a potential implication on how high the neutral interest rate should be given where the fiscal policy is. So Joe Biden has dropped out of the race and the Vice President Kamala Harris is now in the running. But if we compare Joe Biden and Trump in the past two terms and what their record is actually both are pretty bad in terms of running a large deficit. So under Joe Biden, the first 2 years, the US issued $3.7 trillion of debt. And by the third year, he's already issued, by now he's already issued $7 trillion of debt. Whereas for Trump, first couple of years was 2 trillion, and obviously the COVID came in 2020, and so the full term ended up at 7.8 trillion as well. So they're pretty as bad as each other, which took us to just above 35 trillion today. So, but even excluding the COVID-related debt, so Trump issued 4.8 trillion, that's non-COVID related, while Biden issued 2.2 trillion, that's non-COVID related. So neither party seems to really care about, reducing the budget deficit. And I suspect this will be the theme going into the next election, after the next election too, even if Harris replaces Joe Biden as the next president, or if we'll have Trump. I think neither parties are really that bothered about running a large, increasing the deficit. So if we look at the two sets of policies that Harris and Trump propose and their individual impacts on the total deficit. So central to Harris's campaign is raising the corporate tax rate, or higher tax rate. And essentially, she's going to support nearly all of Biden's 2025 budget. And the White House claims to be able to save $3 trillion over the next 10 years. So it's not like this year they will reduce the deficit straight away. It's cumulatively, let's say, 300 to 400 billion each year of surplus. They can reduce 3 trillion in 10 years. So what I have done is I looked at the Committee for Responsible Federal Budget and their estimates of what they think the deficit can be reduced by their individual policies. For Kamala Harris, she plans to raise corporate tax rate to 28%. And the argument is that it's still lower than the 35% that was before the tax law change in 2017. So together, over 10 years, this should reduce the deficit by 1 trillion, assuming it doesn't kill productivity. And she's also on board with the capital gains tax on the unrealized gains. If you are an individual of worth north of 100 million, you should be taxed at least 25%. Essentially, the main concern from the White House and the Democrats is that the billionaires are essentially not paying enough tax because they find all sorts of loopholes. And for example, like Elon Musk, all his net worth is tied up in Tesla stocks, and if he doesn't sell, he doesn't pay tax. But he can essentially borrow money from banks against those stocks to, for example, buy Twitter. But I don't really know how she's going to implement this because there's $100 million net worth. It's sometimes, if you talk about ultra rich net worth, it can be a finger in the air in terms of what your individual assets are worth. So I don't know how they plan to implement this, but I can see on X already a lot of people are really unhappy about unrealized gains. What if in 1 year I've got 100% increase in my stock prices or house asset price, and next year it falls by 30%. What do I do? Do I get money back? And how do I fund this, essentially? So we'll talk about this in a second. So it's unclear how this is going to be implemented or what the impact would be on the deficit. But she also has an agenda to support affordable housing, and that could increase the deficit by 1.7 trillion over the next 10 years. Both parties plan to exempt tax on tips, essentially, and this has an increased effect on the deficit by about 100 to 200 billion dollars. So essentially, the question around Harris's plan is, if you raise the corporate tax rate by a lot, what's going to happen to productivity? Are companies, businesses incentivized to essentially help grow GDP? And what is the trade-off? So you're getting more percentage tax, but if productivity falls, you're actually not getting as much revenue as you think you would. And also, what's the impact on financial markets? Like I said earlier, if I'm a billionaire and I have to sell my shares to fund my tax bill, I have to sell more aggressively than before, than just borrowing from the banks? And secondly, I'm also probably incentivized to sell when the market tanks, so I can have a lower capital gains tax, or harvest some tax losses as well to offset the unrealized gains. So all those things come into consideration, and it could make financial markets potentially more volatile. But we're at the early stage. We don't know how she's going to implement this, so it's hard to say right now what the exact impact would be. For Donald Trump, the main driver for reducing deficit would be tariffs. So if Trump implements a universal 10% tariffs on all imports, it could potentially add $2.5 trillion of revenue. Or if you tax an aggressive tariff on China imports, so I think this means 6%. I think it's meant to be 2.2, but it's meant to be 60%, not 260%. If you increase the tariffs on China imports, you could reduce the deficit by 2.4 trillion if nothing changes. But the reality is your trade partners are likely to retaliate and will not want to export as much to you. And also, so China likely would try to reduce exports as much as possible. So you might actually not get that net effect of, and actually you might be able to, you might happen to tax less because you're getting less imports from China. So it's actually unclear what the actually net impact would be once you put tariffs on your trade partners or China. Trump wants to eliminate the partial income taxation of Social Security benefits. So that could increase the deficit by 1.6 to 1.8 trillion. Tax on tips, exempt tax on tips, we've just covered. But also Trump wants to reduce the corporate tax rate from 21% to 15%. And this can add to, so this has the opposite effect of Harris's proposal, but it could potentially boost the GDP, right? So if it does boost the GDP by, let's say, over 0.5%, we could actually start increasing the net revenue because of the total, you're collecting more tax from a higher base, less percentage tax on a higher base. But if it fails to boost the GDP by this much, then you will end up with a bigger deficit. So I think at the moment, the biggest concern is how would the trade partners retaliate? And if the trade partners also put up tariffs on the US exports, and the US exports a lot of stuff as well, is that going to reduce the productivity of the US businesses? Is it going to make it more difficult for them and therefore increase the chance of recession? And also, by increasing tariffs, you are essentially upping the prices of obviously imports, which can have an inflationary effect. So when you have an inflationary effect, it could essentially lead to higher yields, and it gives less room for the Fed to cut rates, essentially. And generally, if you're running a larger budget deficit, what's going to happen is at the moment that the investors still still see the government treasuries as risk-free, pretty safe. But there will be a point where, if the treasury is issuing a lot of bonds, especially in the longer end, it will increase the supply of bonds. And if there isn't as much demand in the market, if the banks are stretched and in private households don't have as much appetite, the yields will also go up because essentially investors demand a higher term premium, essentially higher return to compensate for the risk of a supply flood. So running a high budget deficit essentially has a impact on high yields and bond prices likely fall. And this brings to an important comparison between the different ETFs we are covering in this service. So IEF, TLH, so IEF is 7 to 10 years, TLH 10 to 20 years. So these part of the curve, which is the mid curve, I think are probably going to be okay in terms of the impact. But for TLH and GOVZ, these are the longer end of the curve, the yield curve, and we might actually see high yields in the longer end, and therefore those prices, the price of TLH, TLT, and GOVZ, may not rise as much as people think. Obviously, all else equal, if these risks don't exist, then in terms of duration play, TLT and GOVZ should outperform the other two ETFs. So it's kind of like it's a trade-off at the moment. In the near term, I don't think this is a big problem. In the long term, it can be if both parties are quite aggressive in running larger deficits. So we just look at this is something. So the New York Fed estimates the term premium. This is on the 10-year bond rate. So the term premium is basically what's the extra yield that the investors demand to compensate for the supply risk that I mentioned earlier. It used to be, 20 years ago, it used to be positive, around 2%. During COVID, it was negative, and now it's coming back up, but still around zero. So basically, there is investors not really demanding an extra yield to compensate for holding the longer maturity. But this trend is going up, and we might see this continue upwards if the deficits go higher. So that's something we can watch. Again, to visualize this on the yield curve, I'm specifically talking about the risk in this area where the yields in the 10, 20, 30-year plus area could go up, which will have an impact on the 30-year yield. A bit more impact on here than over here. So that brings the question, is the neutral rate actually higher than what people estimate? So I think the popular opinion right now is the neutral rate is about 3%. That happens to be where the Fed is projected to be cutting in the next 2 years. So the Fed on futures project the Fed to stop around 3%. A quick definition of neutral rate is essentially the interest rate that's neither contractionary nor expansionary. It would allow the economy to have maximum employment, which is if you want a job, you can find one, and stable inflation, which is, again, is around 2% of PCE. So that's the theoretical neutral rate when the economy is in really good balance. Everything is really good, rosy. But the argument is that the neutral rate might be actually much higher than 3%. It actually could be much closer to 5%, which is the interest rate you have today. So today is Fed fund rate is 5.33%, and the neutral rate could be much closer to this number than where the Fed is projected to cut to. Because remember the charts from page 3. When we had, before 2020, we didn't run, the average deficit as a percentage of GDP was still, just around 100%, 110%. And now it's jumped much higher. And we've been running really high deficits in the past 4 years. So the regime has changed. So tighter financial conditions has been offset by loose fiscal policies, right? Essentially, government issuing handouts during COVID. So that has essentially has inflationary effect, which you will have seen. So that keeps the yield, the neutral rate theoretically higher. And one of the very strong arguments for this revised neutral rate is that we're at 5% today, 5+% today, and asset prices still rising. Stock market is still making all-time highs, and it doesn't seem that financial conditions are that particularly tight. So who's right? Right. So I'm just looking. So I actually spent a little bit of time looking at the past rate cuts since 1992, and we see that the stock market crash usually is just before or at the beginning of the Fed cuts. So in 2000, just before the first cut, and in 2007 was kind of the cuts were already underway. It just started. We made an all-time high recently, and we haven't had the first cut. So we could still have that coming for us, and especially during COVID, we had it topped essentially midway through the cutting cycle as well. But so we still could have topped here, and as the Fed starts cutting, we might have a recession around the corner, and asset prices could fall. So it's still actually unclear whether right now the neutral rate should be higher, or there's just a lag effect of the Fed funds rates being tight. So this is something we should bear in mind as things develop. I don't have the right answer. I don't have the right answer right now. It's just something we should bear in mind, because the thing is, if this is right, the neutral rate is higher, and we start cutting, that's actually really bullish for asset prices, because it's essentially saying we're not that tight and we're cutting. Liquidity is turning up, and we should see even higher highs. And this leads us to the chat about global liquidity. At the beginning of the year, FT published this piece saying the global liquidity index is turning up. It's a 3-year cycle, and we think it won't peak until 2025. this is brilliant for risk assets. And the two biggest components of this index are essentially the Fed and China. And I think overall, this is the right trajectory because the central banks, if you think about what happened over here, the central banks have now finished the hiking cycle. It's been many months, and some bank, ECB has started cutting. So Japan has recently raised rates, but they said they won't do it again anytime soon, or at least they implied that. So it seems like we have the rate cut cycles behind us. China recently revised down the 7-day reverse repo rate from 1.8% to 1.7%. And as we can see, the Fed funds is projected. This is not the Fed funds, but the Fed funds will be cut to just above 3%. And this is SOFR, 3-month futures, which point to the same thing. So I think the big picture is that in the next 12 to 24 months, we should have looser liquidity, which is good, which theoretically is good for risk assets. But bear in mind of the picture I showed you just now, we don't really know what happens yet, just after in the first half of the rate cuts. Again, this is the chart about the Fed liquidity. The Fed liquidity indicator, this is not really an indicator. It's essentially a formula. So the Fed balance sheet minus the Treasury general account minus the reverse repo plus the bank term funding program. So I will go through each individual components to show you why this formula is represented this way. But essentially, the Fed liquidity was up into beginning of this year. We saw the stock market soaring in those 6 months, and it turned down in the second quarter, and in the past month also it is turning up again. So we go through the Fed balance sheet first. So so currently the Fed is doing QT, and it's different to the previous quantitative tightening cycles because instead of selling the asset, the treasuries and the mortgage-backed securities off its balance sheet in the open market, what the Fed is doing is just rolling off the expiring ones, and the pace is 25 billion of treasuries each month and 35 billion of MBS. So this is well telegraphed. I think it will stop at some point next year, probably next summer, just because if they overdo this, it could affect the funding market. We could have the banks could be running tight on reserves. So they don't really want that because if it pushes funding costs too high, if they do too much of QT, it pushes funding costs too high, then it has the opposite effect of rate cuts. It's a bit contradictory. So it's running down. So this is good, nice and steady. The next one is the Treasury General Account, TGA. This is essentially you can think of it as the US government's bank account with the Fed. So when this number goes up, it means there's more cash in the government's bank account. But what that also means is that they're not spending money onto the economy, and that cash comes from somewhere. That cash comes from tax receipts or bond issuances. If it comes from tax receipts, it means money is moving from banks, or the corporation banks or individual persons banks into this government account. If it's debt issuances, it means and it's being bought by the big banks. That also means the reserves, so the money going from the bank's reserves into the government's account. So in net, if this number goes up, it means liquidity gets worse, and theoretically it pressures yields higher. And when this liquidity goes down, the opposite happens. The government spending money into the economy. When it spends money, it means the money is flowing out of this account into whatever the destination bank account is, and that is more liquidity in the market. Banks can take on more risk, lending, investing. So, and the yields should go lower because of this. reverse repo. And essentially, you can think of this as the money market funds lending money to the Fed. They got excess cash and they want to park it with some and get some attractive yields, right? The Fed funds right now is 5.33%. The SOFR overnight rate is 5.33% as well. So if you get 5.33% every day, you're happy rolling this. Versus, if you put into 2-year treasuries, and it's something like only 4%, or not even 4% now. So that's less attractive, especially with loads of the rate cuts priced in. So if let's say if the market only prices in 1 or 2 rate cuts, I think they will be a bit indifferent between doing this and locking in the 2 price cuts in the treasury bills. But now we're pricing in 2 percentage points for the next 2 years. The RRP levels basically hasn't really gone down that much. They're incentivized to roll this day to day and collect that 5.33%. When this level goes up, it means money market funds essentially, taking liquidity away from potentially the treasury market into the Fed, and so that's a net negative for the market liquidity. A bank term funding program. So this is the new program since the Silicon Valley Bank default. Essentially, helps the Fed is helping essentially regional banks to guarantee deposits of the depositors. This funding program reached more than $150 billion in March. It has come down a little bit, which is why the overall picture of liquidity has come down. But I think, I think over time this might come down further, because if the 10-year treasury yield comes lower, which it has, a lot of the banks that suffered heavy losses from holding treasuries could basically see some reversal of those losses, and therefore they're not as pressured to go bankrupt, and therefore there's a less need for this program, and we might see this program getting down in the near future. So overall, that's the formula. So that's why we have all those components in this formula. And you can see, compared with the stock market, they've both went up pretty much between the end of last year and beginning of this year. Although these started to diverge a little bit in Q2, the stock market still ran hot until July, and then we had a carry trade unwind, then it fell. But liquidity has been, essentially because what I said earlier, has been going down until essentially August. But you can see that this bounce back in liquidity could potentially explain this resurgence in stocks. And because I haven't got this the dollar yen graph up now, because right now the dollar yen graph and the stock market, US stock markets, have diverged as well. So it feels like this liquidity chart is explaining the stock market better right now. And if you look at the 10-year treasury yields, worse liquidity, so the blue line, leads to higher yields generally, better liquidity leads to lower yields. But now they start moving in line together in the second quarter, again diverging recently. So and it seems to be, this correlation seems to be back. So it's just something we need to keep an eye on. JP Morgan is saying that because treasuries are not, the government is not issuing that much more debt, so the reverse repo levels won't change that much, and also the TGA levels will go up from 700 billion to 850 billion in the next month. So again, that's worse for liquidity. So it's worth kind of just monitoring this line falling off in the next few weeks, and we can potentially, actually this is a better chart, this line falling off next few weeks, weeks, and SPY also coming down with it. So that's what JP Morgan is saying. So to recap, long-term liquidity cycle should be up, given we'll talk about what we talked about in terms of rate cut cycle, etc. But in the short term, this the Fed liquidity indicator could come down, so tighter liquidity. Moving on to the September FOMC, which is still a month away. We still have a few sets of data before that. So next week, Friday next week, we will have non-farm payrolls. This week we'll have PCE, but because CPI is so benign early in the month, PCE shouldn't throw any surprises. So the big one is really the non-farm payrolls. If the unemployment rate could go up, at the moment, the employment rate is 4.3%. It could go up if there is higher participation in terms of people entering the job market but not being able to find a job soon. And it could move down if people are finding part-time jobs, getting part-time roles. And I think there was some seasonal factors related to weather factors related to the hurricane a couple of months ago, impacting the payrolls as well. So we might see reversal of that. And if the non-farm payrolls come benign and unemployment rate stays the same or goes lower to 4.2, then we should just see a 25 basis point cut. That's what the Fed wants, really. I think they don't mind start cutting in September, but they don't really want to set the precedent of doing 50 big cuts. Because once they start doing 50 in the first one, first it signals the Fed lack of confidence in the economy, especially the employment. It also makes the market want to price in 50 basis points more for the next few meetings. It's not very good for managing expectation unless the Fed really wants to cut aggressively, which I don't think they do. And also on the 11th, we have the CPI. I think at this point, CPI is very benign. It's going to take a secondary role. The risk is that CPI comes into something I've mentioned is the 3-month annualized rate. If the 3-month annualized rate for the headline or services ex-shelter come below zero, i.e. into the deflationary territory, that could also panic the market a little bit because that signals recession ahead and Fed is doing too late. So we might see 50 basis points being brought back to the table again. So these are the two big data points that's coming up. And then a week later, we have the FOMC. September FOMC comes with a fresh set of dot plot, which is what the FOMC members can use to show the projections for the rate cuts for the remainder of 2024 and 2025. The problem with the dot plot is that back in March, I think they showed a median dot plot of 3 cuts for the year. And then in June, they moved straight from 3 cuts to 1 cut. And now if they're cutting in September, it would make the 1 cut a bit silly. So they have to move back down to 2 cuts. So it just makes the overall expectation a bit unreliable. I think projection a bit unreliable because they're just moving the dot plot against the nearest data they've seen. So it doesn't really bode a lot of confidence in the Fed's ability to project their rate path. It will also show economic projections, their year-end projections for GDP, inflation, and employment rates, etc., etc. And I think against the June projections we've already seen, everything is pretty much in line except for unemployment rate, which is too high. So it will be interesting to see where they revise that employment rate in the September meeting. Currently, essentially, we're pricing in 100 basis point of cuts this year, but it's being spread between September, November, December. Essentially, the market is saying we expect a 50 basis point cut at some point, but we don't know which meeting. So we're going to spread our bets a little bit. So this signals 20% chance in September, all the way from 100% chance a few weeks ago. But here we are, 40% chance in November or 40% chance in December. But anyhow, most of the cuts should be done before the second half of the year next year. And we get to just above 3% by end of next year. So this picture hasn't changed much in the past week. It's just the bets have been more spread now in the front meetings. All right. Does anyone have questions before I move on to the next part? Please feel free to ask. Okay. All right. So then let's move on to part 2, which is about setting up a trade. So yesterday I wrote about how to set up the trade with the right risk reward and how to mathematically position your risk position for each trade. And I give so for me the math is this, right? If I'm running a 100K portfolio, it doesn't matter what the size it is actually, but the math is a bit more round using this figure. I only want to risk 1% of my portfolio for each trade. And this could be, if I like Tesla, I could spread around 2 trades. I could do a half percentage point for 1 trade. And then if I gain confidence, I can add position to get to the 1% limit. So if I want to lose less than 1%, which is 1K on a 100K portfolio, and my stop loss is 20%, my position should be $5,000 in this trade. So if my Tesla shares lose 20%, since I bought in, I will lose $1,000. And this is really important because theoretically we have, in my trade setups, I have, TLT with a 4% target, Bitcoin with a 30% target. It doesn't mean that I should put more money into Bitcoin and less money into TLT because my target is small. What it actually means is the opposite. Because I have a bigger stop loss in Bitcoin, I should actually take a smaller position. So in the event either of my trades, TLT trades or Bitcoin trades, doesn't work out, I should lose just under $1,000 for each trade. It shouldn't be the case that I lose way more money, 10 times the money in Bitcoin than TLT. It should be that every time I lose about the same amount of money, and proportionally, depending on my risk reward ratio, I should win more or less the same. But if I have higher reward to risk ratio, I would win more money. Again, if the stop loss is 10%, the position should be I misplaced the comma, but this should reach $10,000. And ideally, the risk reward I prefer 3, but I think 2 is okay. So if the reward to risk ratio is 2, it means you can be wrong 66% of the time and still break even. If the reward ratio is 3, then I can be wrong. I can be wrong 75%. I only need to be right 25% of the time to break even. And if this ratio is 1, I need to be winning 50% of the time. And actually, if you think about reward to risk ratio, if a high reward to risk tend to need a longer time frame, it tend to be a slightly longer term trade, and therefore, actually, the risk, the chance of me being wrong is actually higher. And if I'm playing a much shorter trade, then I think it's okay to have a lower reward to risk because the chance of me being right is probably higher. There's less path of being wrong essentially. And I would just say that try not to force a setup. So yes, we want a reward to risk ratio to be above 2 or 3, but if it doesn't exist, if you've done your technical analysis, if you've done your fundamental analysis, and you just don't see it being there, don't try to just do the fancy chart setup and say, okay, then let's target this random number here on the chart just to get the right number. Because that doesn't work. That's just kind of random. I usually watch a few tickers, I plan in advance and say, okay, if the trade gets to this level, I would buy in. And I've been tracking Bitcoin for a while publicly in this service. So before I trigger the trade, I actually know exactly what I want to get in, pretty much. And I would get in as soon as that trade is flat. So I would say stay patient. Sometimes you'll miss the trade because it doesn't, the pullback is not shallow enough. It's too shallow, it's not deep enough, etc. I just wouldn't chase. There are loads of opportunities all the time. And for example, even if you have a trade that has a stop loss of 10% here, you're committing 10% of your capital, which is a lot into a trade. So in any time, if you have a couple of trades, depending on position, you're already committing a lot of capital to those trades. So I really wouldn't try to force it. How to set the stop loss? I think the stop loss is the first thing I look at when I enter a trade. I don't actually look at the reward first. I actually look at the stop first, because where to exit is really, really important. I can't stress it enough. You can set the stop loss looking at the chart logic, for example. So here, I basically track to say, I think the wave C has finished, and that should have finished wave 4. I could be wrong. Therefore, I'm setting up my stop loss to be just under this wave 4 or this wave C of wave 4, right? If it breaks a new low, then it means, at least it means, even if it rebounds straight away, at least it means things are not manifesting the way I expect, which means I should reassess the situation, right? This stop loss shouldn't just be like, don't think of it waving the flag of your theory or of your thesis. It's like, this is an opportunity to take a deep breath, and say, okay, things are not going exactly what I expect. Okay, let's look at the picture again. And let's wait for the right signal again to get back in. And on this chart, so the stop loss 15 and the reward is 60%. So this is 4-1. So actually, my chance of getting this right, I'd like to think is 50%, but because I've studied Bitcoin, I have this confidence. But I actually never know the underlying true odds, right? Because obviously I don't know until the trade finishes, and also even when the trade finishes, I either I've won or lost, which is a binary result. I can only iterate my analysis over time and get my, look at my win rates and say, okay, so maybe I was overconfident, or maybe I was too bearish, etc. before, and I can adjust my analysis accordingly. So, but having this risk reward gives me a lot of room for being wrong. And to be honest, there is a lot of room to be wrong, because we have to go get to wave 3 target, and there's a wave 4 pullback, which can always be a steeper pullback, and we try to get to wave 5, right? A lot of things can go wrong in here, and it's Bitcoin at the end of the day as well. It's not like a high dividend yielding asset. So this is how I think about it. So for this setup, I've used the chart. But sometimes you also have to check with the standard deviation. Basically, one standard deviation is the range of historical behavior from mean. One standard deviation covers 68%, range of how the stock historically behaved, and then 2 standard deviations covers 95%. Generally, I think the stop loss should be at least 2 standard deviations away from the mean, just because if it's within, let's say, 1 standard deviation, then the chance of your trade being stopped out is pretty high, right? So over here on the net downside, if we're looking at just the downside, we're talking about 16% chance, which is like 1 in 6 or 1 in 7. So you don't want your trade to be randomly knocked out by the asset's own volatility within 2 weeks. That's not really helpful. What we really want to do is we set a stop loss that's wide enough that it only theoretically it should only happen 2.5% of the time. So when it does happen, first hopefully it doesn't happen. It doesn't get triggered straight away, so we still stay in the trade regardless of the noise. But if it doesn't happen, we can really something, there's usually a big market catalyst. For stocks, is usually the earnings or negative guidance or some sort of negative news. For Bitcoin, it could be a large whale selling its coins, for example, like the German government did a month ago. So having this as a minimum stop loss is useful. So if you're trading on the daily chart, this should be the daily. But if you're trading on the hourly chart, you can look at this on the hourly, because the hourly standard deviation will be smaller than the daily. So your stop loss could be tighter. And if you're trading minutes charts, vice versa. It's just a useful guidance, I think. Even if you're not using it, you just sort of understand where the stock, how much stock moved today is attributed to random noise versus the outliers. So I use silver as an example because we are already in the silver trade. We've been in the silver trade as LSLV since 26. But let's say if you want to enter today, right? And you say, okay, I want to play wave 3 here to 32. And I want to use this green, the lower side of this green bar here as my stop loss, which is 2%. And wow, like the risk reward is really good. The upside is 17.5%, the downside is only 2%. If it doesn't have to work out that often for me to be lucrative. But the thing is, this is really tight. You are subjecting the trade to random noise from daily movements. So the 2 standard deviation, the 1 standard deviation for LSLV is 1.8%, and 2 standard deviation is 3.6%, and the mean is slightly higher. So from the mean, it's negative 3.5% to the downside. So, like if you are within this 3.5% range, the trade can just get knocked out quite easily by daily volatility, right? And actually, your chance of success is greatly reduced just because your stop loss is too tight. Whereas if you set the stop loss to below this red bar here, 3.77%, at least you're removing a lot of the chance of random noise knocking your trade out of the stop loss, which gives you a better chance of success. So it's just another factor that we need to think about when we're placing chart setups. And also, so another stop loss method I mentioned is look at historical earnings. So NVIDIA has done pretty well, obviously, but the worst one-day reaction is 8.2%. And something, for Facebook, it could have been like 15 to 20%. So that stop loss could be higher if you're running Facebook into the earnings. And I've been waiting for this trade. I can talk a bit more later about the NVIDIA setup. I think we are in wave 3. So we've had wave 1, wave 2, and wave 3 here. And this is below the all-time high still. But there's a chance that we can, but it does look like potentially we're in 1, 2, 3, wave 4 pullback, and we can get to wave 5. And this has been pretty much standard Fibonacci levels. The wave 3 top is 1.618, extension of wave 1. So I'm essentially waiting for a wave 4 pullback here. And once I place the trade here, my chart logic would say the stop loss should be 6%, because the wave 4 low shouldn't really be overlapping with wave 1 high. So if it breaches wave 1 high, it means my trade is probably invalidated. I probably wouldn't get the wave 5, and this is just a three wave up, or it's a truncated wave 5. So the third wave here, fourth wave here, and wave 5 is just really shallow. It just means the stock is exhausted in its momentum. But if, let's say, the earnings wasn't tomorrow, but the earnings is somewhere, here, in the future, I did get this pullback, I probably want to place a wider stop just in case we go into earnings, there's so much riding on the earnings, and NVIDIA miss the expectation or provides a lower guidance, etc. Then the stock plunges 80%. This is the worst. 80% is the worst one-day reaction since for the past 3 years. So it's fairly reliable. But if I had a stop loss of 6% and it plunges 8% just on earnings and I'm out of my trade already, it could be in a tough spot, right? Because it kind of doesn't, this whole risk reward, it doesn't make sense if it can just plunge by 8% on earnings. So that's something we would think about placing a trade like this. And I just want to talk about psychology. I think most people won't make money trading, and this is because by human nature, we're loss averse, and we are emotional. And what this means is when we lose money, or when something hits our stop, it's really emotionally hard to let go of the trade because we feel like our thesis is so right. How could it go wrong? We have our ego attached to it. And second, we're hoping that the market will just bounce back to break even, so I don't have to crystallize the unrealized loss into a realized loss, unless I'm trying to harvest some tax losses for the tax season. So we become particularly risk-seeking, irrationally risk-seeking when we're losing. And when people lose, they tend to dial up the size of the risk position. They want to take on big bets to get back to break even as quickly as possible. But actually, this is exactly what you should. The opposite is true. You should actually dial down your bets because first, you're not as level-headed as you used to be, and secondly, if you think about the stop loss, dollar value of stop loss, if my portfolio has shrunk from 100,000 to 90,000 because of I lost money, my 1% stop loss has also become smaller, right? Become not $100 rather than $1,000. So I should be making smaller bets when I'm losing and making larger bets when I'm winning, because the utility of each dollar gain is actually rapidly reducing when I have more money. But usually when people start winning, they start taking profits too early. So the reward to risk ratio looks great on the chart. It's 3 or 4. Well, then the stock is up 10%. We're like, okay, let's bank the gains, right? So we actually never realized that risk reward ratio. So what ends up happening is that people are refusing to cut out when they're losing 10%, but they will quickly, bank their gains when they're up 10%. And, if every time you place a trade and you're losing more than you gain on average, then over the long term, you're going to lose money in your performance. And what I often see is that because we're loss averse, we have an inability to enter a trade. For example, if NVIDIA does really come down here, a lot of people probably won't fancy it anymore. They're like, it can go down all the way here, like it's probably topped. But actually, if you've got the trade set up here, you have to pull the trigger because this is a process. You're not riding on the wings of any individual trade. You're trying to do volume over time. And if you want to be in the game long enough, you have to execute those trades as you plan it. Unless the fundamentals change, right? Unless the CEO resigned, then it's a different story. Then you reassess whether the fundamentals have changed, etc. But if it's just price movements, you expect to pull the trigger here on the pullback to win the wave 5, and the time comes and you're like, actually, wave is sells off further, and you don't pull the trigger, then you miss out on this opportunity again. Again, inability to cut losses, which I said, and inability to ride winners. And actually, what most people do is that if they have a winner, they have a loser. What they want to do is they will bank the gains on the winner and double down on the loser because they're averaging down. So over time, your portfolio will just look like a bunch of losers, like trying to bounce. Actually, Kathy Wood's ARK stock is probably the case right now. she didn't take profits on the winners. Now they are losing, and she's doubling down on those losing positions, and the fund is underperforming. All right. Any questions before I move on to live charts about all the setups? Because I remember you were keen to explore the math behind all of this last week. So please feel free to ask. All right. Okay. So I'm going to stop sharing this one, and I'm going to move on to sharing my trading view chart. Okay. So, all right. So for the first few tabs, I'm just going to track the trades we still have. Then I'll move on to the potential setups in Amazon, NVDA, Meta, and potentially Google as well. So for TLT, not much have changed since last week. I think the market is just waiting for the next set of catalysts. We're still under the wave 3 high. So we're still not clear yet on whether we can break out. I think non-farm payroll will be such a catalyst. We have PCE this week, I think on Friday, which could, if the PCE numbers come in low, we could also push this higher. But at the moment, it's kind of just hovering below the wave 3 high. Still have the target here, wave 5. So after wave 5, we might get a pullback here before we head higher, right? And that pullback could coincide with the Fed liquidity stuff I mentioned about September, TGA, Treasury general account taking higher, repo levels staying the same, etc. We could get a pullback from there. Or if we go into the September rate cut and the Powell just basically says, we're not going to give you further guidance because it's data dependent. We're going to take each meeting as it is. There's nothing mechanical about the cuts. Again, market to say, okay, fine, like maybe we're too aggressive in pressing the cuts. We'll pull back. So I think the catalyst for going up is non-farm payroll, CPI, and PCE before the FOMC. And then we got the liquidity factors and the FOMC next month for the pullback. If you're a pure chartist, they will say never watch the news, etc., etc. Just look at the charts, which we are doing. But I think the bond market does trade with the Fed a lot more than other assets. So it's not completely pure technical. We're marrying the fundamentals and technicals together in this one. But it's just useful to know what the potential catalysts are and being ready to act. Again, TLH is the same. The charts are basically the same, just different numbers. We're still looking for a wave high here. So I think we are progressing. We just need to clear this wave 3 high and head towards wave 5. Bitcoin is an interesting one. So this pullback has been a bit steeper than what I expected. So just to recap on where we came from, August 5th crash, we made a low. We had a 5-wave sub into wave 1 high here quite quickly. And essentially, since then, I had been waiting for wave 2 pullback and ABC pullback, which we got. And it's here when I start flagging the trade, 57.7K. And actually, it's been really constructive since, because the wave 3 target was reached at 1.61 extension of wave 1, almost exactly to the mark. But it's cleared the previous wave 1 high. So overall, I think this is a really bullish path. If I can just look at, the traditional charter support here, it, we are having a wave for pullback. Typically, when we reach 1.61 extension, the pullback is round 1 extension. We have made below this extension now, but still sitting about 0.78. I think when it breaks below 61K, that's when my warning signs, that's kind of like early warning sign that the trade may not work out. This pullback is too steep. And of course, when it overlaps with wave 1 high here at 60K, okay, that makes me think that maybe we won't get to this wave 5 target. I have to rethink about where this chart takes us. But right now, it's still intact. The wave C is quite steep. We've had 5 waves in wave C. And for me, I think wave C has completed, or at least is very close to completion. If you look at where we started wave 1, 2, so wave C is just near the 2.382. So it has room to get to this 61.4K. But again, below 61K is an early warning sign that this trade setup might be faltering. I haven't got a trading stop loss on this one because I'm playing the daily chart and my target is around 92K. So, and my stop loss is 49K. So this is the region on a bigger time scale. Doesn't worry me too much yet. It's just a very tiny pullback in the grand scheme of things. My stop loss is below here, this wave C low, and my target is here with 5 high. This is the minimum target. So I don't have a stop loss right now, and we'll just take the trade as we go at the moment. Yeah, so it's just made a bit more ground as we speak, which is always fun to watch. Yeah. All right. So moving on to gold, GLD. The bigger picture is that we're wave 3 of wave 3. So it's a very bullish, but essentially we're very close to the wave 3 target. And it's completely my fault because when I start covering gold, we are already around here. So there wasn't enough upside. If I start covering gold over here, maybe we would have had a setup. So essentially, I'm waiting for a wave 4 pullback, and we can enter here for wave 5 target of 278. Silver does have a setup. We entered at 26, which I mentioned earlier, and I plan to ride to just below 34. And the reason there is a setup in silver and not in gold is because silver has been lagging. So the gold silver ratio has ticked up. Silver has been historically on the cheap side versus gold, judging by the past 2 years. So it's playing catch up now. Overall, gold is in a bullish setup. So the overall direction, I'm bullish on silver as well. The only caveat is that if we have a recession on the way, then silver behaves more like a commodity, like copper and lead, than a precious metal like gold. So central banks are buying gold and not silver, and that's a major weakness of silver. And that's also a major weakness of Bitcoin. Central banks are not buying Bitcoin yet. Maybe Trump will change that, but it's not the case yet. And actually, just on that point, I think Trump, even if Trump wants to make a Bitcoin reserve, I think US government has like $2 billion worth of Bitcoin. The easiest way is not to sell and just hold on to it. But it depends on what the Biden administration or Harris's administration want to do as well. They might want to sell ahead of Trump getting elected, if he gets elected, ahead of the election. So it just makes building the Bitcoin reserve a bit harder. So gold is the winner so far because of central bank buying. Tesla is a very good example of us talking about stop losses. When I entered the trade around here, we had a 1-2 setup. I wanted, so my initial target was actually 228, wave 3 high. And we actually got here, but in fairness, I feel really bad about entering a spreadsheet and saying, oh, this trade is completed, because literally it reached 228 for a brief moment on the open on the 20th. And actually, if you didn't have a automatic take profit order, you would have missed it. So it doesn't really help. But after this, I did warn our chat that wave 3 could have reached, and we're in a wave 4 pullback. And I was riding the wave 4 pullback for wave 5 with a trading stop loss of 210. It didn't reach the trading stop loss last week. It actually, in fact, bounced back. And it just basically couldn't push through this resistance, which used to be the support. And it became slightly range bound between those two levels. And today it broke through the trading stop loss. And essentially I stopped out. And it traveled even further at 206. So this is a really good example, because when it breaches this level, it still could be a wave 4 pullback. It's just a slightly steep one. And we can get down to 205. So we got to 207 today, but it could go down to 206, 205. And if it doesn't overlap with wave 1, there's still, this setup is still valid. But what I want to do is I want to see essentially kind of like confirmation that this wave C has ended. Whether it's ended today, which means I just got a bit unlucky, which is fine, or actually there's still room further to go. If I'm looking at something like the 5-minute chart, just looking at those wave C here from the wave B high. So if we had a 1-2 setup, so wave C tends to be 5 waves, and wave 3 is 1.61 extension, which I mentioned earlier, of wave 1, and wave 4 had quite pitch perfect, 1 extension, pullback, and then wave 5 at 2.38, which is a bit steep, which basically took me out of the trade. So wave C has enough to say, it's sufficient to say, okay, it could be done here, right? But what I'm trying to watch is that, do we get a 5 wave up from here to signal that this trend has reversed? Can I get something like, this, right? So a wave 1 up and a wave 2 pullback for me to re-enter the trade probably around 210 again, right? I don't care whether it's exactly 210 or 211 or 209. It doesn't matter. But I want to see this 5 waves up and a 3 waves down correction to give me a new setup for wave 5. And the beautiful thing is, once I have this new setup, I can reevaluate how much position I want to take. I can evaluate whether I want my new trade setup to, if I was entering here, where this stop should be, probably 2 standard deviation on the daily chart, and aiming for the wave 5 high, etc. So I'm actually entering a completely new trade if that setup arises. And if the setup doesn't arise, so if it does a 3 wave bounce and tops up here and goes further, I've saved money, right? So it's a win-win. Where I got out of here, where I entered, that's the old trade down. I banked 6%. That's it. I could have banked 15. I didn't. That's fine. It hit my trading stop loss. I just move on, and I'm looking at the new setup for next one. So this is essentially how I think about trades. And the thing is, stock like Tesla is very, very volatile, so it gives us a lot of opportunities. So missing one setup is not end of the world. All right, okay, so let's move on to the next one. Amazon. So Amazon, I'm actually long myself already, but I only started covering the stock last week, and it was already over here. At the time, I've highlighted that we're waiting for 1-2 setup here. So we have 5 waves up, and that's sufficient. We now just need 3 waves down, and it hasn't formed yet, but we could have something like this to take us. So wave 2 here is a 0.61 retrace from of this entire wave 1. And if we enter here, we can play all 5 waves, or if you want, you can actually just play to wave 3, which still gives you a nice reward to risk. And the stop loss I would use is the August 5th crash again. If it goes lower, this might not be a 1-2 setup. What could it be is a larger A, B, C pattern. And then we get stopped out. If we get stopped out here, and we can just wait for the ABC pattern to finish, and then try again at the wave 5. Overall, on the larger scale picture, I'm very bullish about Amazon, because first it's valued pretty cheaply against other mega caps. I think Jeff Bezos was selling around 200 to fund his yacht or Blue Origin project, but I think that selling wave is probably done now. But regardless of the billionaire selling, I think on the larger scale, I still see Amazon going much higher. And I think Amazon will be one of those, Amazon, Microsoft, Google, these are all going to be century long companies that power the economy. So I don't think we're done yet in the cycle. NVDA, yeah, go on.
Oh, sorry, quick question, Richard here.
Yeah.
So
Richard.
your suggested entry point for Amazon, because I am definitely interested. I'm long but looking to add. Your suggested entry point would be 165 thereabouts. Is that right?
Yeah. So this is an estimate right now, because we need to see where this ends. But this number essentially comes from the fact that if it's a wave 1-2 setup, usually it retraces to 0.682, and if it's a steeper retrace, is 0.236. If it retraces further than this, it's basically not very bullish for the stock. So this is what I've tentatively marked. Essentially, what we need to see is we want to see a wave B bounce here, and then we can see, okay, where wave C is relative to wave A. The wave C is typically same length as wave A from the top of wave B. So we don't have wave B yet, but once we have it, is either one extension of, so equal length to wave A, or 1.236. So it's just slightly higher than wave A. So I think once we have more clues, I will definitely trigger, I will flag the trade. So, but it's just really nice to have this set up already, and then see, and then get ready when we ready to bounce.
Got it. So we're really just waiting to see where A ends and B begins, and that should help us to determine C.
Yes, that's right. Yeah. And also, once the wave C begins, we'll also have clues with the 5 waves down, like wave 1 and 2, and we can deduce how far wave C could be from there. So we'll get much more clues as we get. We're slightly early on this setup yet. I'm just putting those entries here just to say theoretically we can get this setup, which is worth watching. Also, this setup is in Google Sheet now. I didn't have it, but I've entered it today, just and with all the charts. So if you want to track over time, of course, just check the sheet as well. So I update it quite frequently.
Will do. Thank you.
No worries. Moving back to NVIDIA. So tomorrow is the earnings. Just looking at, I think we went through this last week and also in my write-up. And NVIDIA has never missed, essentially. And it rarely prints below 2% one-day reaction. Those two dots here, 7% and 8%, happened in 2021, and we were in a bear market. And I think this was before this was before ChatGPT. So essentially, if you exclude those two dots from 2021, the earnings is very big. So I don't think we're going to get a pullback tomorrow. We might even get higher. So ideally, I want to see this set up. We might never get it. When the chart is really bullish, we might just have a very, very shallow pullback wave 4. And we just get to wave 5 straight away. But unfortunately, the risk reward is just not there if I enter. I mean, yeah, even if you just use this as a stop, this is not really worth playing. I mean, you can try to get hopeful it goes up to 148, but who knows, right? I think 148 will be a new all-time high as well. So I probably wouldn't. So I'm still patient essentially on this. I wouldn't short the stock right now. The reason is I'm writing Meta now, but from all the mega caps I've covered so far, people are heavily spending on capital expenditure to build the AI infrastructure, and they just seem to be hungry for chips. Amazon is even developing its own chips. So I think NVIDIA is still hot, even if it's not growing as fast as it used to. It's still playing a big part in this cycle. And it is, if the stock has run up so much here compared to all-time high, to me, it feels like it should break past it, or at least it would try to attempt the all-time high again. So I would be cautious shorting this right now. Yeah, so I'm waiting for the setup. We might still get this downward reaction tomorrow. If it happens after the earnings tomorrow, we get this setup. I think a lot of people will have the psychological block trouble to pull the trigger, as I mentioned before. But this is something we have to do, essentially. All else equal, the price come down here. We just need to pull the trigger and play this out. And because the stop loss is quite tight, we can afford a bigger position on this. One scenario I didn't mention is with the stop loss is that sometimes, I did sort of cover, sometimes you get on a random day, the trader is here, let's say the price is here, it was within your stop loss, and then suddenly it drops through here, then what do you do? And it's really, really difficult when that happens, because it's not like, if you started here and the 2 standard deviation takes you here, that's fine. But if you started here, you haven't been knocked out and it goes down here. And that is not something, there isn't a perfect solution to dealing with that. If it goes through your stop loss, obviously, if you have an automatic order, the broker will just stop you out with maybe a slippage, which is fine. But it really goes through there. You just, either you play the charts and say, okay, is there a likely bounce? If not, what I tend to do is I assess on the day, is there a likely bounce? Can I get a slight recovery on it? If I can, I'm patient, I will try to exit so I don't take the slippage, too much slippage. But otherwise, if it's close, otherwise I usually just get out of it. And I think the problem is probably more to do with the setup. And I'll probably have to rethink about the setup next time than regretting on the trade. And I'm just saying that could happen with the stop losses. It's just something we have to deal with over time through experience. Meta, the analysis will be with you. I've done all the analysis, but I just need to write up the actual essay. I think the top, we still have some room for the top. Essentially, I missed the ball on the August 5th crash for Meta. But I'm just essentially waiting for this pullback if I can get it. If I can't get it, it's quite tough, because if you're entering now, to play this wave 3. First, there isn't really obvious place I can place this stop on the chart. And the reward risk is just not quite there. Yeah, I mean, maybe this works, but this is kind of random. So for me, I could have missed this, but I spent a bit more time looking at this chart and thinking about the setup. But potentially we have a setup here, and it will come with the essay tomorrow. So I need to spend more time on this. Google. Before I started service, I think I wrote a free article on Google, and at the time, I had wave 3 here, wave 4 here, and I said wave 5 has topped. But since covering all the other mega caps, I started re-looking at where Google is in the cycle. And to me, if the cycle wave 1 top was the financial crisis, it didn't exist before the .com crash. The financial crisis, wave 2 low. And I think we had a nice run into cycle wave 3 up until the bear market of 2021. And you know, the 3 of cycle 3 was COVID. Then we had a big post-COVID run, which ended the cycle. And I think we're in wave cycle 5, and the cycle 5 could be north of 350. Which is 2 extension of cycle wave 1. So in the long term, I do think there is room to run, which means, and to me, essentially the reason I've revised, I think we've only had a wave 3 top in July, and we're in the wave 4 correction as opposed to this overall top. You could have said this is wave 3 because it's a 1.764 extension, so that suffices in wave 4, and then we have a wave 5. The problem is for me is that if this was a 3, 4, and 5, this wave from this wave 4 low to this wave 5 high is pretty extended. It's almost like a 2 extension from the wave 4 low. And not that I'm saying that it couldn't happen. I do think structurally, it doesn't feel like we're at the top yet. We should be at wave 3. And with seasonality, September, all that stuff, and election before the election, we could have further correction down to here, and then we can finish up at wave 5. And that after that, we could have a bigger correction, and then finish at the cycle 5. But it doesn't feel like wave 5 we've completely top yet. And also the problem I had with this wave potential being wave 5 is that relative to the wave 5 of cycle 3, this is too shallow as well. So it just feels very incomplete right now to me. So I think that's what we have for today. Again, the webinar overrun, but I've recorded everything. Feel free to catch up on the charts. Does anyone have questions right now regarding any of those setups? Yeah, so there's no setup on Google, so I'll keep an eye on it. It's just I wanted to update my Google spreadsheet to say, instead of saying this is in the top, maybe we'll have one more leg to go. Yeah, so any questions about everything we've covered today? It could be about the deficit or yields, etc. Don't be shy. All right, okay, so it's getting late. Thank you for tuning in today. I'm glad we've covered so much ground again today. And if you have any follow-up questions, please just ping me on the chat. And yeah, thank you.
Thanks, Yimin.
Thank you. All right, cool. Bye-bye.